Have or thinking of getting a limited company whilst being employed? Well, this is the video for you. As a business accountant, my team and I spend all day long helping business owners on their journey, and a very common scenario these days is that somebody who's employed, they've got another job, looks to start a business on the side. It's very common, and I think it's a great way of looking at whether you want to be self-employed or have a business, because it's not for everybody and it's a good way to test the waters. And then that's quite a natural transition, is as you start then to make enough money, people will transition over to their business full-time, or they might do it slower, cut down some of their hours at work and do more in the business. So very common. And then that leads on to the question of, well, should I be limited or should I be a sole trader, a self-employed individual or not, or a limited company? And there's a few things to consider. And in this video, I just want to talk about those considerations. So before we get into it, if you like this type of video, make sure to click the subscribe button below so you get notified whenever we release more content just like this. So let's get straight into the question of, well, not should I be limited, because we've done a video on this already and I definitely check that out. There is a video called Should I Be Limited, and it talks about the pros and cons. But I suppose it's why might you want to be limited if you have another job? And it's actually a very important question, because when it comes down to tax, when we talk about limited companies for people that aren't employed, one of the things we'll often talk about when asked as accountants, should I be limited, is we'll say, well, how much money do you earn? Very personal question to ask somebody when you just meet them, but that is the crux of it. And if they're going to earn in their business, and forgetting any other income, but if you were going to earn in your business, say around 30k, 30,000 a year profit, and it's not an exact science. There is an exact science to it, but for multiple reasons, it would depend on your personal circumstances and other things. But let's just say as a ballpark figure, if you earn a profit of around 30 grand, you'd normally be saying, okay, limited company makes sense, because you're going to save enough tax that it's going to outweigh the costs of having it. And the costs of having limiteds are one of the key things we're going to discuss in a moment, because I think it's a consideration you need to really understand before forming one. But normally that would be the rule. You'd think about 30k. Now, and the reason that is because you're able to efficiently use all of your allowances. So you've got like a personal allowance where you can earn 12.5 grand at the time of recording this video as an individual each year, tax-free. You can earn up to £50,000 without paying higher rates of dividend tax, which is something you use generally to get money out of the business. And you use a combination of salary and dividend to get money out of the business very efficiently, not pay any national insurance, but not have any downsides to it. It all works out quite nicely. Now, when you've got another job thrown in the mix, what happens is those allowances are gone. If you've got another job that you're earning over £12,500 in, you've already lost those allowances. They're used in your job, so you're probably not paying any tax in your main job, or you're paying less because they're using that allowance. So if you're earning 30, 40 grand, they're going to be using that 12.5 grand, so that every month you get your pay slip, a proportion of that allowance is being used, so you're not getting taxed on it, which works out fine, because it just means in your job you're getting taxed appropriately. Now, if you were to go self-employed, so not have the limited, you would be paying tax at either 20 or 40%. Now, where this changes massively is if you're a higher rate taxpayer, so you're earning over £50,000, then the question of whether you should be limited or not is that limit. When I was talking about 30k profit of a person without any other income, you're actually looking at things like so let's say you're earning 60 grand in your main job, you might only need to be earning 6-10 grand for it to make sense to have it in a limited company on the side for your side business, because you're paying 40% tax. Now, I can't go too deep into a video, but let's just say it's worth chatting to a professional about. If you've got any aspirations of doing even 10k, the tax saving on that alone would be quite substantial, having it in that company, depending on what you were going to do with the money. So one of the key things with limiteds is they're great for because a money box to store your profits in. The question, because you'll only pay tax currently at 19% of corporation tax in that company. Now, if you're paying 40% in your job, 19% and national insurance, 19% seems a massive saving. So that's great. But what happens is when you take the profits out, you're going to pay some secondary sort of taxes, if you like. So you might pay some dividend tax, or you might pay, if you were to pay yourself salary, which probably wouldn't be a good idea, you would also end up incurring more taxes. So you do pay second taxes. So a lot of the question would be around whether you need to take that income out. So something that people do quite frequently is they might have they might buy a property in a company. Now, I'm not going to go into that because that is an entire video to itself, and there's a lot of practical reasons why you might not want to do that. But some people do that, and the reason is they don't actually need the income from that property, and it sits in there and it builds up over time, and then they're only ever taxed at that 19% until they need it. And the tax planning point around that is trying to figure out, well, how do we make sure when you do need that money that you can draw it out? And that's the same with the side business. So you might start having this side business and earning money in it, and then it's building up in there, and at some point you've got to decide, how am I going to take that money out? And that's where working with a professional can help you make sure that you're using the most of your allowances. In general principles, you're probably, if you've got another income that earns over £12,500, whether you're higher rate or not, and you have this limited company, you're probably not going to want to declare yourself any salary, because if you imagine it'd be the same as your employed job, it is a lot of the time it's not going to work. Not always, there are some income levels where it still makes sense, but as a general rule, then you're looking at dividends. Now, if you've not heard the term dividends, normally as an owner of a limited company, you're going to be the owner, the shareholder, and that means you can take profit out of that company in what they call dividends. And again, there's another video on the details of this, but you'll take these dividends. Currently, at the time of recording, you get £2,000 a year tax-free in dividends. So if you've not got any other dividends, that's a nice way of getting £2,000 from your company without paying any of these further taxes other than the company's main corporation tax bill, this 19%. So it's a really good way to do that. So that's one little thing that you might want to do. Even if you didn't necessarily need to draw that money, you still might want to declare that dividend just to make sure you're using those allowances, because they are kind of a 1-year deal. Once if you don't use them, they're gone. You can't sort of go, well, I haven't used them for the last 4 years, I'm going to use 4 years worth. It's done each year. So that's something to consider. But generally, yeah, you might start to take it as dividends. You might also think, well, I don't need the money initially, and there are some things you can do with pensions, for example. There's a lot of things you can do, and having the limited company gives you some of these options. It also gives you the option that you could potentially, if you've got, now I'll use uni-age kids as an example because it's a common one I've seen over the years, but they're very much like, okay, can I have some money? Oh, make them work for it, employ them. You could potentially start a payroll scheme up and have them employed by the company to do some work, and then at least and especially if they've got allowances, because as an adult child they're going to have the same allowances as you, that 12.5 grand a year tax-free. You could potentially pay them for the work they're doing. Yes, there's some paperwork involved, but if you do it properly, you're going to get a corporation tax deduction on the money you're paying them. They're going to get it tax-free, and it's a very tax-efficient way, and I don't know, a very moral way of making them earn their keep, really. So definitely think about those. So there's quite a few things that are going on in that picture. But if we just come back to, should I be limited then, in that case, with another job? One of the big things to consider early doors is cash flow and also just cost. So if you've got no appreciation for if you're going to earn any money, it really is speculative. The biggest problem with limited companies is that you're almost always going to need an accountant to file the paperwork. If you're a sole trader, so you are an individual, you just have a personal tax return. Now, I'd always, because of all these 22,000 pages of tax that you're looking at over my shoulder, say you should have an accountant to look at those things for you, because they're going to know the rules and make sure that you're paying the absolute minimum amount of tax, the correct amount of tax that you should be paying. But ultimately, you could do it yourself. You know, you could log on. There's a free tool. It's doable. With a limited company, that's actually for filing the corporation tax and the full accounts and things like that. There isn't a free tool to do it, and that's why we even have here accounting clients who just don't have the software to do it. So you're going to need an accountant. Now, that is quite a lot of paperwork to do in a year, and let's just say complete ballpark, you're going to be looking to spend about £1,000 a year with an accountant. So you've got to think, if I'm going to form this limited company, am I going to cover it? Yes, it's a tax deductible grand, which is great, but still got to generate £1,000 somewhere to then be able to pay those costs. And again, that is complete ballpark. It just varies between accountants and what you actually want done and everything else that goes with it. And surprisingly enough, there's another video on that on the channel. But you should, yes, consider that there is this overhead, this cost that you're going to have to fund. And that's the biggie for me. Quite often we get approached by people and they're like, I've got this company, I traded it for like a month, it's not really done anything. And you tell them the cost and they're like, oh my God, because they haven't done the research that you're now doing by watching these videos and doing the research to find out, was it a good idea in the first place? So if you're really not sure, it could be worth starting off as a sole trader and then moving over into this limited company. But if you have done the limited company, you're thinking, or you're absolutely set on it, then that is a consideration. Now, the other reason you might want to do limited companies is people like the limited company protection. Limited liability is a protection. At the end of the day, it protects your personal assets and puts this layer in front of you and the clients and the customer. So that's really good, especially if you've got something where you're concerned about liability, that you're doing a fairly risky job. You know, yes, you can get insurance and things, but it is that layer in front, which is quite good. And some people like the professional look it gives them. You know, it's searchable on Companies House. It always sounds quite nice to sound the director and the owner of. Some people love the CEO title. I'm not sure on that one for a small business, but that is also an option that you can have as well. So All those things in there that make limited also quite attractive. Now, if you've heard me talk about all that and think, actually, yeah, no, it still sounds good to me, so let me get that right down, I can sort of money box my money in there, pay 19% corporation tax at the time of recording, and then when I draw that money, I'm going to pay some more taxes. That sounds okay to me. I don't necessarily need them right away. Brilliant. I understand there's some things I can do to take that money out fairly efficiently. Great. I understand that I need to bear in mind that at some point when I want that money, if I'm not using my allowances efficiently, I'm going to end up with a relatively chunky tax bill when I do that. So I've got to be thinking about those things. And you think, yeah, brilliant. Still sounds like it's a good idea for me. I understand there's a cost involved with it. Brilliant. Then the thing I would say to you is when you're forming it, or even if you have formed it, consider whether you want to have another shareholder involved in this, because one of the things that are possible is with these dividends and taking money out is, let's say you've got a significant other in the household that you share your finances with. It can be very tax efficient to share the split of income between you, often in different ways. So you might have one of you earns more than the other one, and that's a massive tax planning point, is to be able to split the dividends potentially between the two of them, between the two of you. So just consider that as you go. And again, if you need any specific advice on that, definitely contact a professional and they'll be able to talk you through the pros and cons of doing it. But that is a really important thing to consider. And that, I believe, is some of the key considerations that we get asked a lot from people. Now, like everything, I think it's important that if you've got a very specific scenario, especially where you're involved in other jobs and other incomes, it's worth talking to a professional about whether it's a good idea or not. But hopefully that just gives you a feel for some of the key issues that you should be thinking of. So I think that's it. If that answered your query, please do let us know below. If there's anything else that you'd like covered in this type of video, do drop it in the comments below and we'll see if we can get that in a future video. So that's it. I hope you've enjoyed it. Please do share it with your networks, like and subscribe, and we'll see you on the next one.